Here is something that will make you deeply uncomfortable. If you think about it honestly, most of the financial mistakes you have made in your life, the investments you panicked out of, the purchases you regretted, the savings you never built, were not made because you lacked information. You knew saving was important. You knew selling during a crash was probably a mistake. You knew that impulse purchase was unnecessary. You knew, and you did it anyway. Because the part of your brain that makes financial decisions is not the rational, logical, information processing part you think is in charge. It is the ancient, emotional, fear-driven part that evolved to help your ancestors survive predators, not navigate the New York Stock Exchange. And until you understand how that part works, it will keep costing you money every single year. For the rest of your financial life, consider this research finding from Nobel Prize winning psychologist Daniel Kuhn. The pain of losing $100 US is psychologically approximately twice as powerful as the pleasure of gaining $100 US. Your brain does not process gains and losses symmetrically. It is profoundly, irrationally, evolutionarily biased toward avoiding loss, even at the cost of dramatically worse long-term outcomes. This single psychological quirk, called loss aversion, is responsible for more destroyed American retirement accounts than any market crash in history, because it causes people to sell their investments during downturns, converting temporary paper losses into permanent real ones, and then miss the recovery that follows every single crash in market history. In this video, I am going to walk you through the 6 specific psychological biases that are costing American investors real money right now. For each bias, I am going to show you exactly how it works in your brain, exactly how it manifests in financial decisions, and exactly what you can do to override it permanently using specific behavioral systems rather than willpower. Because willpower runs out, systems do not, and the Americans who have built the right financial systems, who have designed their money life to work with their psychology rather than against it consistently, outperform the Americans who rely on discipline and information alone. Stay until bias number 5, because that is the one that affects the Americans who consider themselves the most financially sophisticated, the bias that causes people who read financial books, follow financial news, and actively manage their investments to consistently underperform ordinary Americans who simply automate their contributions to a boring index fund and never look at their portfolio. Understanding this bias alone and the research behind it could add hundreds of thousands of US dollars to your lifetime investment returns. Let's get into it. The psychology of money and why you make bad financial decisions, even when you know better. In 2002, Daniel Kahneman became the first psychologist to win the Nobel Prize in economics. His life's work, summarized in his landmark book, Thinking Fast and Slow, established something that fundamentally changed how we understand human decision-making. Human beings do not think with one system, they think with 2. System 1 is fast, automatic, emotional, and intuitive. It operates below conscious awareness. It makes snap judgments. It runs on pattern recognition and emotional association. And it is extraordinarily powerful, generating an answer to almost every question before your conscious mind has even formulated the question. System 2 is slow, deliberate, logical, and effortful. It requires concentration. It can reason through complex problems. And it is the system we like to believe is in charge of our important decisions. The problem, and this is the insight that won Kahneman the Nobel Prize, is that System 1 is in charge far more often than we realize. Including during financial decisions, when the stock market drops 30% and your portfolio is down $50,000, System 1 fires immediately. It generates fear. It generates urgency. It generates the overwhelming impulse to do something to stop the pain, to sell before it gets worse. System 2, the rationale, logical part, knows that crashes are temporary, that selling locks and losses, that every previous crash has recovered. But System 1 is faster. System 1 is louder. And without specific behavioral systems designed to counteract it, System 1 wins. Every time. at enormous financial cost. Morgan Housel, author of The Psychology of Money, one of the most widely read personal finance books of the past decade, captures this insight elegantly. He writes that doing well with money has little to do with how smart you are and a lot to do with how you behave. Intelligence is not the variable that separates Americans who build wealth from Americans who do not. Behavior is the same information, the same understanding of compound interest, index funds, and the importance of saving produces completely different financial outcomes depending on the behavioral systems the individual has built around their money decisions. Housel's research shows that a person with average intelligence and excellent financial behavior will dramatically outperform a highly intelligent person with poor financial behavior every single time. The evidence for this is everywhere in American financial data. Highly educated Americans, doctors, lawyers, engineers, go bankrupt at startling rates, not because they lack intelligence, but because high income creates high spending, high lifestyle expectations, and often high debt, and intelligence alone does not protect against the psychological biases that cause spending to always expand to match income. Meanwhile, the research of Thomas Stanley and William Danko in The Millionaire Next Door found that the majority of American millionaires are not doctors or lawyers. They are ordinary Americans, teachers, small business owners, farmers with moderate incomes who built wealth over decades through consistent, disciplined, psychologically sound financial behavior. Now let's go through the 6 specific psychological biases in order of the financial damage they typically cause and build a specific behavioral fix for each one. Because understanding bias without a fix is just knowledge that makes you feel informed while your portfolio keeps suffering the same consequences. The goal is not to eliminate these biases. They are hardwired into human neurology and cannot be removed. The goal is to build behavioral systems that make acting on them impossible, or at minimum extremely difficult. Bias number 1. Loss aversion. This is the foundational psychological bias in all of personal finance, and it is the one responsible for the single most costly financial mistake ordinary Americans make. Loss aversion was first documented by Daniel Kahneman and his research partner Amos Tversky in the 1970s. Their research found that losses are psychologically approximately twice as painful as equivalent gains are pleasurable. Losing $1,000 feels approximately twice as bad as gaining $1,000 feels good. This asymmetry is not a personality quirk. It is a hardwired feature of human psychology built by millions of years of evolution. Loss was literally a matter of survival. In financial markets, loss aversion manifests as panic selling. When markets fall, and they always fall, sometimes the psychological pain of watching your portfolio decline becomes unbearable. The balance that was $200,000 is now $140,000. The loss feels real, immediate, and permanent. System 1 screams sell before it gets worse, and millions of Americans listen. They sell at the bottom, converting a temporary paper loss into a permanent realized loss, and then watch the market recover without them. Research by JP Morgan found that an investor who missed just the 10 best trading days of the past 20 years, often days that occur right after the worst days, earned 54% less than an investor who stayed fully invested through the entire period. Loss aversion does not just cause a bad day, it causes a permanently worse financial life. The fix for loss aversion is not to try to feel less pain when markets fall. That approach will fail because the emotional response is automatic and involuntary. The fix is to design your financial life so that the opportunity to act on loss aversion is removed. Automate your investments. Set up contributions to your 401k and Roth IRA to transfer automatically on payday. Before you see the money, before you can redirect it, remove your portfolio tracking apps from your phone. Commit to checking your investment balance quarterly, at most annually, is better. When a market decline inevitably arrives, you will feel the fear. But your automated system will keep buying, and that continued buying at lower prices will produce the superior returns that patient investors have always generated from market panics. Bias number 2. Present bias, also called hyperbolic discounting. This is the psychological tendency to value immediate rewards dramatically more than future rewards, even when the future reward is mathematically superior by a large margin. Brain imaging research shows that when humans think about future rewards, the prefrontal cortex activates the rational planning center. But when an immediate reward is available, the limbic system also activates the ancient emotional reward center, and it competes with and often overrides the rational decision. The result? Your brain genuinely cannot value the future the same way it values the present. It is not a matter of discipline or intelligence. It is neurology. Present bias in personal finance looks like this. You know that contributing $500 more per month to your Roth IRA starting today will produce approximately $680,000 in additional retirement wealth over 30 years. You understand this intellectually, but when the choice arrives, in the real moment, $500 today feels like $500. The $680,000 in 30 years feels abstract, distant, almost fictional. And so the $500 goes toward the vacation that felt vivid and real and immediate, rather than the retirement account that feels theoretical. This happens not because people are irrational. It happens because the human brain evolved to prioritize immediate, certain rewards over delayed, uncertain ones even when the math overwhelmingly favors the delay. The fix for present bias is the same elegant solution as the fix for loss aversion: automation. Pay your future self first automatically, before the present self ever sees the money. The moment your paycheck arrives, your automated system moves money to your Roth IRA, your 401k, and your investment account. Your checking account receives only what remains. The present self never had $500 to choose between investing and spending. The choice was never presented. The future self wins by default. This is called paying yourself first, and it is the single most powerful behavioral intervention available for overcoming present bias. Not discipline, not willpower, not better intentions. Automation, every time. Bias number 3. Herd mentality, also called social proof. This is the deeply human tendency to look at what other people are doing and assume that the crowd must know something you do not. In social situations, following the crowd is often reasonable. If everyone runs from a building, it is probably on fire. But in financial markets, the crowd is almost always wrong at the critical moments, because financial markets are driven by the same herd mentality, and by the time a trade or investment has become so popular that the crowd is aware of it, the best return opportunity has already passed. The data on herd mentality in financial markets is brutal and consistent. Bitcoin reached its 2021 peak of approximately $67,000 when mainstream media coverage was at its highest, when taxi drivers and grandmothers were buying it, when the herd was fully committed. It then fell to approximately $16,000 by late 2022, when the same herd was selling. The stock market peaked in February 2020 when CNBC was running all-time high graphics, and crashed 34% in 33 days. It bottomed in March 2020 when every financial headline was predicting permanent damage. The herd bought at $67,000 Bitcoin and sold at $16,000. The herd sold stocks in March 2020 and missed one of the fastest recoveries in market history. The herd is reliably, consistently, expensively wrong at every extreme. Bias number 4. Anchoring. This is the tendency to give disproportionate weight to the first piece of information encountered the anchor when making subsequent decisions. In financial markets, anchoring manifests as reference price fixation. A stock that traded at $100 and has fallen to $60 feels cheap because the anchor is $100. But if the company's fair value based on earnings and growth is $40, the stock at $60 is actually expensive. The anchor is irrelevant to the investment decision, but the brain treats it as a crucial reference point. Anchoring also causes investors to hold losing positions far too long, because selling at a loss relative to the purchase price anchor feels psychologically unacceptable, even when the rational decision is clearly to redeploy the capital into a better opportunity. Bias number 5. Overconfidence. And this is the one I promised you, the bias that costs the most financially sophisticated American investors the most money. Research consistently finds that approximately 93% of Americans rate themselves as above average drivers. Statistically, this is impossible, but the same overconfidence extends to financial decisions. A landmark study by behavioral economists Brad Barber and Terence Audion found that the more frequently American investors traded worse their returns. Men who were more overconfident than women in the study traded 45% more frequently and earned 1.4% less per year as a result. And the Dalbar Research Organization, which tracks actual investor returns versus market returns, found that the average American investor earned approximately 3.7% per year over the past 30 years, while the S&P 500 returned approximately 10% per year over the same period. The 6.3 percentage point gap, compounded over 30 years, represents an absolutely staggering amount of destroyed wealth, and it is driven almost entirely by overconfident active trading decisions. The Dalbar research finding deserves to be repeated because its implications are profound. The average American investor earned 3.7% per year. The S&P 500 earned 10% per year. The difference is not market conditions. It is not bad luck. It is behavior. Specifically, it is overconfident trading driven by the belief that active management and market timing can produce better results than simply buying and holding a low-cost index fund. Decades of research, including from Nobel Prize winning economist Eugene Fama, consistently finds that the vast majority of active fund managers underperform simple index funds over long periods, and individual investors, making emotionally driven active decisions, do even worse. The fix is simple but psychologically difficult. Own index funds. Never trade them. Add to them every month. Stop. Bias number 6. Mental accounting. This is the psychological tendency to treat money differently depending on its source. Even though money is completely fungible, a dollar is a dollar regardless of how it arrived. But the human brain does not experience it that way. A tax refund feels like found money, a windfall, something to be celebrated and spent. A year-end bonus feels separate from salary, as if it belongs to a different mental category where different spending rules apply. An inheritance feels like money that was never really yours. Money it would be almost disrespectful to put in a boring index fund rather than spend on something meaningful. These mental distinctions are entirely psychological. They have no basis in mathematics, and they consistently cause Americans to squander lump sum financial windfalls that invested would have transformed their financial trajectory. The research on tax refund spending in America is illuminating. The average American tax refund is approximately $3,100. Studies show that the majority of Americans spend their tax refunds within weeks on discretionary purchases that provide no lasting value. If instead, every American who received a $3,100 tax refund invested it in a Roth IRA annually starting at age 25, the result by age 65 would be approximately $798,000 in additional tax-free retirement wealth from the tax refund alone. That money was earned. It was taxed. It belongs to you as completely as any paycheck. Mental accounting. The psychological trick of treating it as found money is the reason most Americans never capture that $798,000. Now, let's talk about the antidote to all 6 biases, because the biases cannot be eliminated, but they can be systematically neutralized. The most powerful tool in behavioral finance is the written investment policy statement, a document you write in advance when markets are calm and you're rational. System 2 is fully in charge. That specifies exactly what you will do with your money under every circumstance. It specifies your asset allocation. It specifies what triggers It specifies that you will never sell during a market decline of any magnitude. It specifies that every tax refund, bonus, and inheritance will be invested within 30 days. It specifies your monthly contribution amounts. It is your rational mind giving instructions to your future emotional mind before the emotions arrive. Warren Buffett has described his investment philosophy in terms that perfectly capture the behavioral solution. He says his favorite holding period is forever, and that he makes decisions as if the stock market is going to close for 10 years the day after he buys. By mentally committing to a holding period so long that no short-term price movement could possibly matter, he short-circuits the loss aversion and herd mentality that destroy ordinary investors. By maintaining extraordinary simplicity, owning businesses he understands, buying when others are fearful, ignoring daily price movements, he eliminates the opportunity for overconfidence and anchoring to corrupt his decisions. Buffett is not just a great analyst. He is the most behaviorally disciplined investor in American history. Here are the 7 behavioral rules that the wealthiest and most financially successful Americans consistently follow. Rules designed specifically to neutralize the 6 psychological biases we have discussed. These are not investment strategies. They are behavioral guardrails, systems that protect your financial decisions from your own psychology. Rule 1. Automate every investment contribution. Never manually transfer money to your investment accounts. Set up automatic transfers that occur on payday, before the money reaches your checking account, before your present bias has an opportunity to redirect it toward immediate consumption. Rule 2. Never check your portfolio more than once per quarter. Remove investment apps from your phone. Reducing the frequency of portfolio observation reduces the opportunity for loss aversion to trigger panic decisions. Rule 3. Write your investment policy statement today. 1 page, specifying your asset allocation, your contribution amounts, your rebalancing rules, and your commitment to never sell during market declines. Sign it. Keep it somewhere accessible. Read it every time a market decline or financial news event makes you want to deviate from your plan. Rule for only index funds. Eliminate the overconfidence bias entirely by removing active investment decisions from your portfolio. V2I view, VX. US set your allocation, automate your contributions. Never actively trade. Let the market's long-term growth work for you instead of working against you. Rule 5. Treat every dollar identically regardless of source. Tax refund, bonus, inheritance, gambling winnings. Apply your standard financial rules to every dollar that arrives in your life. Invest the predetermined percentage. Spend the rest. No mental accounting exceptions. Rule 6. Never make a financial decision during an emotional state. Market crash, wait 48 hours before making any decision. Unexpected windfall, wait 30 days before deciding how to use it. Major purchase impulse, wait 72 hours. The emotional state that generates financial urgency is almost always System 1, and System 1 is almost always wrong about financial decisions. Time is the simplest and most effective deactivator of emotional financial decision-making. Give your rationale system to time to engage. The decision will almost always be different and almost always better. Rule 7. Read 1 book on financial psychology per year. Not financial strategy. Financial Psychology. The Psychology of Money by Morgan Housel. Thinking Fast and Slow by Daniel Kahneman. Your Money or Your Life by Vicki Robin. Your biggest financial returns will come not from better investment picks, but from better understanding of your own mind. Here is the final truth about the psychology of money that every American needs to internalize. The financial system, the media, the investment industry, the advertising economy is specifically and deliberately designed to exploit every one of the 6 biases we discussed. Financial news creates urgency and fear that triggers loss aversion. Advertising exploits present bias by making future consequences invisible and immediate pleasure vivid. Social media feeds herd mentality by broadcasting everyone else's spending and investment decisions. The financial services industry profits from overconfidence by selling active management products that underperform passive index funds. You are not swimming against your own psychology. You are swimming against your psychology and $1 trillion industry that profits from from exploiting it. Building the 7 behavioral rules into your financial life is not just smart investing. It is self-defense. Let's bring it all together. The psychology of money and why you make bad financial decisions. 6 psychological biases hardwired into human neurology. Bias 1: loss aversion causes panic selling. Fix: automate investments and stop watching. Bias 2: present bias steals retirement contributions. Fix: pay your future self automatically before you see the money. Bias 3: herd mentality buys high and sells low. Fix: own index funds and ignore financial news extremes. Bias 4: anchoring distorts value perception. Fix: evaluate investments on fundamentals, not price history. Bias 5: overconfidence destroys returns. Fix: index funds and never actively trade. Bias 6: mental accounting wastes windfalls. Fix: treat every dollar identically, regardless of source. Here is my challenge to every American watching this video. Today, identify the one bias from the 6I. Describe that you recognize most clearly in your own financial behavior. Just one. The bias that has cost you the most money. The one you can see clearly in your own financial history. Then identify the specific behavioral fix, the specific system that would neutralize it, and implement that system today, not next week, today. Drop a comment below and tell me, which of the 6 biases is your biggest financial enemy? I read every single comment and will personally reply. Every good financial decision you make today, your future self will thank you for. The best time to start was yesterday. The second best time is right now. If this video helped you understand why you make bad financial decisions and how to fix it, hit like and share it with one American who needs to understand their own financial psychology. And if you want to know how to retire early with the FIRE movement, step by step, that video is right here. See you there.